Hey, what's going on? This is TerrenceRe, and I'm going to do a live today. We're going to talk about the meeting tomorrow at Jackson Hole with Jerome Powell. Does it matter? And what the market is saying about that meeting. All of that and a little bit more right after the buffer. All right, right now we're showing that the VIX is down, what, 0.75%, down 0.75. I'm right over here on my watch list. We got the S&P futures up about 36 handles. That's almost 1%. NASDAQ futures are up about 1%. The Dow futures up about 0.5%, and the Russell futures up a little over 1%. We got the bonds are up. Oil futures are down, and gold is up about 6 handles, but that's relatively flat. Bitcoin, that's is down 0.5%. The Bitcoin futures, which is basically, that's basically flat for Bitcoin. The dollar seemed like the dollar has been raging. If you look over here on the chart, I have a 1-year chart up, and you can see the dollar has just been beasting to the upside. So we almost look like we got something like a double top up here. It could bust out and continue to go higher, but the dollar's been on a rampage lately. So so basically, out of the majority of the S&P 500 is up today. So one I wanted to talk about. So tomorrow, Jerome Powell will be speaking at Jackson Hole. I think that's in Wyoming or something like that, and he's going to be addressing basically what's being talked about on the news anyway: inflation, what they're going to do with the outlook for the market, and be a lot of economists there and a lot of academia. But what I wanted to talk about today is, do you really need to know that to be able to invest or trade in the market? But my position is that unless you're like a day trader, and you may need to pay attention to stuff like that, because if you're trading on like in and out of positions on the day, but for the average investor, you're just buying and holding. You don't care about that. You holding your stocks. One thing I would say is, like, if you're holding stock positions, you might want to look to sell, options against the stocks that you own. Maybe sell calls against them to limit your downside risk. So what I wanted to look at is the SPX. SPX is the S&P 500 index, and it's purely options. So you can't buy stock in this particular underline. So if you wanted to buy stock in the S&P 500, you would do that by buying the ETF, the SPY. But we use the SPX, or I do, to look at what the option market is saying. The option market, a lot of times, by way of the VIX or looking at the option chain, we can see the risk that is being priced for tomorrow. So I'm going to pull up I'm on Thinkorswim platform, and depending on which one I'm using for the day, you may see me using Thinkorswim or either Tastyworks, but today we're going to operate in Thinkorswim. And you can see I'm going to come up to, we have an option expiration, a weekly, that is expiring tomorrow. We also have one expiring today. Well, we're going to look at the one that's going to expire tomorrow on August 26th, Friday. So this is the one that if you were that's going to tell us like what's being priced in about what Jerome Powell is going to say tomorrow at Jackson Hole. If we look all the way to the right, we see right here it has a plus or minus 50. That is the expected move, plus or minus $50 from right now to the end of the market tomorrow. It's a plus or minus $50 move. That's not a whole lot. it's a nice little move for the day. Give an example right now as I'm doing this video, we're up 37 bucks on the day. Now, so what that's saying is now in the high, let's see, the high today was 41.83, and then the low was 41.47. So that's about 36, right? About 36 bucks, 36, 37 bucks. So that they're saying that tomorrow with this news, we got plus or minus a 50 buck move being priced in by the option market. So that's telling you that it's a big nothing burger. The option market is telling us that we do not have a big move priced into tomorrow. Now that doesn't mean that something can't happen between now and then, the end of the market close tomorrow, that can make the market move. These things are termed generally, you hear the term loosely thrown around as a black swan event, something like that. He'd have to do something outside of his normal character, and something would have to happen globally or something to spark the market to move. Because right now the market is saying that, hey, it's going to be a regular day like today. It's almost as if he's not speaking. They're only factoring in an extra from what we have today of 38, an extra 13 or 14 bucks. Now, one thing we'll do, what I want to do in this video right here is now let's look at it. Let's visually look at it. I want to show you something. I'm going to come up here and I'm going to click on the Analyze tab. Now on the Analyze tab, I already have it set up. I have the date up here. I say 27 because you go the day after the day that you're looking at that's going to expire. So Friday expires, that's the 26th. That option expires at 4 o'clock when the market closes. So I'm using the next day. Excuse me. And you see I have a probability range of 68.27%, which is basically a one standard deviation move in the market. Basically, that's a one standard deviation move, period, of just about anything. If there was a criteria for good drivers, let's say, and they had like a score range for drivers, 68. I mean, the majority of people would score whatever that average score is. 68% of the population would be in that average, and then you would have another 16% to the top. You'd have another 16% toward the bottom. Outside of that one sigma or one standard deviation move, it's about 32%, right? So if you're looking at this, I have it set up 1 sigma plus. You see that sign -1 sigma over here. And if I'm going a little fast, you can always, first of all, hit the like button, hit the subscribe button. You're not gonna find this in too many places, not for free on the internet. So what I'm doing is showing you what a one standard deviation move would look like tomorrow. And I'm using the SPX because that is the top 500 stocks, right? And so with that being said, that's generally how you get as the S&P 500 goes. So there goes the market for the most part. If you look, the SPX is up to date, and look at, you can look at everything else: Apple, Amazon, Google, Microsoft, which they're all in, Boeing, Caterpillar, Netflix. The only one that's down a little bit is Tesla, and that really ain't a whole lot, $3. So if you look up here, you'll see 33.87% and 34.30. Basically, see it is moving. It's going to add up to 68%. So it would be normal. It would be a normal range for the market to stay right into this range by close of business tomorrow. Anything within here would be normal. So what I like to do is I'm giving you some information so you will say, well, Ray, how is this applicable to investing and trading? Well, if you know the trading range, right? So you will look at your portfolio and say, how much risk can I handle? Right. So can you handle a move like this? You can do this with any stock. the more liquid the stock options are, the better you're going to have as a form of reference. This is just telling you that like the mark, anything within here is normal. It's like a normal or a normal range. So if you wanted to trade that, like you could come in here and you could say, hey, I don't think that the market is going to go outside of one standard deviation. Now, there are a couple of things that you can do on the option chain to achieve that. I normally use delta to choose my strike prices, but I could come up here where you see delta and change this to come down here to option theoreticals and Greeks, and I can change this to probability of in the money, of touch, of out the money. Now, if I do that, what I'm going to do, I'm not going to do it where it says delta. I'm going to do it where it says volume, and I'm going to show you why. So let's see, not out the money. We'll do probability of in the money, and you're going to see that it's really close to your deltas. So right here, you see they got a delta of 8 for this option, and if you look, it has a probability of 8.26% of being in the money. That means, like you looking at this, these on the call side, this is all in the money, right? So if that means if I sell a call, if I was to come here and click and try to sell a call at the 16 delta, right? That means that, so I'd be collecting 500 bucks if I lock that in right there. So what that means is this 16 delta, and if you look over here, probability of in the money is close to the delta. It says 15.66%. So that's telling you that there's a probability. It's only a 15% chance that this option will close in the money tomorrow when the end of the market session closes. So what that's saying is, you're saying, well, if you do that, you're saying you're selling the expected move. You're saying, well, I'm saying that the market's not going to move outside of that range. This range over here, 51%, it's going to stay within. So, excuse me, $51. So if I went 51 plus 41.85, what's that? 42.35. So actually right here. So 42.35, that would be your expected move. So I came out to, the 17.16 delta. So you could probably move up one if you just want to sell the expected move. So you're basically saying, I don't think that whatever he's going to say is going to be a big deal. So I'm going to sell the call. It won't go higher than that. And then if you want, you could come to the bottom and do the same thing. Come down here where it says probability in the money. I would probably do like 15 and then sell that. And it's almost, you actually getting a little bit more for selling it equidistant put. And then that's just a do about, with skew. So you see right here where it says you got a strangle. So all you're doing right there is selling the expected move. So when I take this lock off, there you go. You see the price change. I had the lock on. When you lock that price in, it won't fluctuate. So 1140. That's $1,140 is what you would be collecting in premium if you sold the expected move. You're saying that, he gonna talk a lot of smack tomorrow, but the market ain't gonna do anything. And that's what I'm saying. If you look at the headline of the video, I'm saying, is it important? Like, is it a big deal? Do whatever he says, does it matter to the market? I'm showing you that the market is pricing in movement. Like everything is already priced in at this point. What we've been looking at in the charts and this down move is the Fed has been behind this move. The market, before the Fed even started raising rates, the market was already going down. The market was already going down before they even started raising rates. And we still have high inflation. So they're going to continue, more than likely, they're going to continue to raise them. But it doesn't seem like the market found a bottom. You know, we got a gap here off of this low. It broke this trend line and then popped right back in. And now we're up against this trend line up here at the top. Now, no one knows what the market is going to do, right? If you know, like how do you know? You should know. But with my technical analysis and what I think, I do trade I trade what I think. So I'm gonna do a little book talk. Let's see. So with me thinking that it's gonna break out to the top, how would I trade this? Using options. Let's go to the SPY, which is a smaller product than the SPX. You got a lot of you got big money. You trade the SPX, right? You got a little small account. You want to trade the SPY. It's a smaller, more tamed animal. They call the SPX the widow maker because how big it is and how much more margin and how much more money you need to trade it. And it's not quite it's liquid, but not quite as liquid as the SPY. This is probably the most liquid, I want to say, underlying to trade, period. So when you come to the SPY, let's take a look at the trade tab. Now, you're going to see, I closed up everything. You see right here, I'm out in September, 36 days. I have a put spread out here. You can see right here, I'm going to open up the chain. And then we're going to take a look at it. So what I did was I sold the 402 and then I bought the 397. That's a $5 wide spread. Like currently right now, I think I'm up about 30, 35 bucks on it. 37. I may close it out at the end of the day. I don't know. I may hold it through the meeting. We'll see what happens. But basically, this is a bullish trade because I'm on the put side. So you may have heard that like puts, if you buy a put, then yeah, you're placing a bet that the market will go down. But I sold this put, and instead of leaving it naked, then I bought a wing. So what that does is that caps my loss, right? So it's a $5 wide spread. The most I could lose would be 500 bucks. But in selling this put right here, I took in premium and I took in 141 bucks. So that taking in that premium, that makes my risk about, I think, 359. And I just need the market to stay. The market can come down around here. I just need it to stay here, and then I can make profit off of it. And I can make profit by the market moving up or by volatility contracting. So that's one of the benefits of selling options. You don't necessarily have to directionally be right. You can get paid on theta decay. Now let's look at the analyze tab, and then we'll wrap this up, and I'll let you guys get out of here. We'll see what. So now I got it pulled up, and as you can see, I think I already got it set for my break even. You can see that my break even is right here at $400.61, which means all I need is the market to stay over here. And you can see that there's a 72% chance that the market will stay on this side. So that's what you call a high probability trade, right? So I got a 72% chance of it staying here. And if I look to manage the trade early, instead of trying to keep the whole $141, which is what I'll do, I'll manage it, I can increase my probability of success by managing at 50%. So that's kind of the short spiel on getting long, selling puts or selling put spreads. And also we went over the expected move. If you got something out of this video today, do me a favor, hit the like button, hit the subscribe, but go over to YouTube and subscribe. This is my first time doing a live on LinkedIn. But I do most of my lives on YouTube. So if you want to subscribe on the YouTube channel and hit your likes over there. And if you're in LinkedIn, do the same thing. Share the video. I'm always doing option tips. I'm always talking my book. I'm always trading my book and doing live stuff. And with that, guys, I'm out. Peace.